It's the third Friday of the month, and the paycheck just landed. For about 6 seconds, it feels like good news. Then rent or the mortgage takes its bite, the car payment follows, groceries that used to cost half this much disappear into the cart, insurance renews at a higher rate than last year, a student loan payment hits, the credit card statement reminds you it still remembers last December, childcare invoices itself like a second rent, the electric bill climbs because everything climbs now. A few subscriptions you forgot you had quietly renew. Gas prices do what gas prices do. And somewhere in there, a $400 repair shows up uninvited.
By the time it's all accounted for, the number that's left barely resembles a paycheck at all. Then, almost out of habit, you open your phone, and there's a 26-year-old standing in front of a house they just closed on. Another one bragging about investing $4,000 this month. Another one already retired. You're 32. You're not behind on anything that shows up on paper, yet somehow it feels like the race started without you. So here's the real question, the one nobody answers honestly. What actually happens to your life? If you're 30, you have little or nothing invested, and today is the day you finally decide to start.
Here's what's true about you, even if you've never said it out loud. You are not lazy, and you are not irresponsible. You went to school, you got a job, you paid what you owed. Mostly on time, you helped a parent when they needed it. You survived years where prices rose faster than your paycheck did. You handled emergencies you never budgeted for, because nobody budgets for emergencies. You still tried, here and there, to actually enjoy your life. And somehow, despite doing most of it right, you reached your 30s without the financial footing you assumed would just appear. Friends are buying homes. Your parents are aging in ways that quietly worry you. Kids, if you have them, are getting more expensive every year, not less. Your career feels less guaranteed than it used to. And retirement, which once sounded like a word from a different decade entirely, suddenly doesn't feel that far away. So let's actually walk through what the next 30 years could look like, starting now at 32.
The first year isn't dramatic. It's a Tuesday night with bank statements open on a laptop, finally adding up what the credit cards actually cost in interest each month. It's deciding to stop transferring the balance and start shrinking it instead. It's cutting 2 subscriptions, not 12, because the goal is sustainable, not miserable. It's building a small emergency cushion, maybe $1,000 at first, sitting in a high-yield savings account instead of a checking account earning nothing. It's checking whether the job offers a 401k match and contributing at least enough to get every dollar of free money the employer offers, because turning that down is the closest thing to walking past cash on the ground.
It's setting up an automatic transfer of $300 a month into an index fund, something boring and diversified, the kind of investment that doesn't try to be clever, not a bet on one company, but a small slice of hundreds of businesses at once. So no single rough quarter from one stock can derail the whole plan. None of this feels impressive. None of it gets posted anywhere. And it will get interrupted. A car repair eats the emergency fund in March. A medical bill arrives in June. The landlord raises rent in the fall. And for a few months, the contributions pause while life gets handled first. That's not failure. That's just what year 1 actually looks like for most people. By 35, something quieter starts happening. The panic that used to show up every time an unexpected bill arrived starts fading. The emergency fund, slowly rebuilt, can now absorb a flat tire without wrecking the month. The 401k balance is still modest, but it's real. And the automated $500 a month into the Roth IRA and index funds keeps showing up, whether or not it feels exciting.
The Roth IRA works a little differently than the 401k. The money goes in after taxes now, but decades from now, in retirement, it comes back out without the IRS taking another bite, which matters more than it sounds like it does at 35. By 38, the feeling slowly shifts from barely surviving to something closer to stable. Not wealthy, stable. There's a difference, and it matters more than people admit.
Then the 40s arrive, and with them, more income, but also more expenses, pretending to be necessities. A bigger house starts to look reasonable. A newer car starts to make sense. Vacations get more expensive. kids' activities multiply, and social pressure quietly suggests that earning more should mean spending more. This is the actual fork in the road, the one most people don't notice until it's behind them. The version of this person who increases their investment contributions every time their income rises, moving from $500 to $800 a month, then higher, ends up in a dramatically different place than the version who lets every raise dissolve into a larger mortgage, premium subscriptions, and the unspoken competition of looking financially fine on social media. Now, picture the other timeline, because it exists for almost everyone watching this. Picture the person who waited until 42 to start, telling themselves they'd begin once they earned more, once every debt was gone, once they finally felt ready. On the surface, 10 years doesn't sound like much, but in practice, those 10 years of compounding don't get refunded. The version who started at 32 with $300 a month, using a reasonable historical average return, never guaranteed, but a fair illustrative assumption, could realistically be looking at a portfolio in the high six figures by their early 60s, simply from staying consistent and increasing contributions over time.
Push that same discipline to $800 a month once income allows it in the 40s, and the trajectory shifts again, not because of a single lucky year, but because of decades of the same unremarkable decision repeated on schedule. The version who waited until 42, even if they start with a larger amount, has to contribute far more aggressively every single month just to land somewhere close. Waiting doesn't just cost money. It costs years the market can never give back, and it forces the older version of yourself to work harder for less time. None of this happens in a financial vacuum. Housing costs more than it used to. Mortgage rates make starter homes feel out of reach. Rent increases outpace raises in most cities. Student debt lingers longer than anyone expected. Insurance premiums climb every renewal. Childcare can cost as much as a second mortgage. Healthcare deductibles eat into savings faster than people plan for. Groceries quietly cost 40% more than they did a few years ago. Jobs that used to feel permanent now feel conditional. And there's a real reasonable fear that Social Security alone won't be enough to retire on comfortably. All of this is true. None of it means starting is pointless. It means starting matters more, not less, because nearly 3 decades still stand between 32 and a traditional retirement age, and that is enough time for consistency to actually work. Here's the part that matters more than any account balance. Wealth doesn't first show up as a big number. It shows up as the ability to pay for a car repair without spiraling. It shows up as being able to leave a toxic job without immediate financial disaster. It shows up as helping a parent without wiping yourself out, covering a medical deductible without panic, taking a week off to be with family without losing sleep over it, saying no to bad debt, sleeping through the night, and making decisions based on what you actually value instead of what you're afraid will happen if you don't follow through. The first real transformation isn't becoming rich. It's becoming much harder to financially destroy, and that shift alone changes how every other decision in your life gets made. And here's the realization that actually matters most. You do not have to fix every financial mistake from your 20s in the next 12 months. You only have to stop repeating them for the next 30 years. That's it. Not perfection, repetition. In the right direction for a long time. Consistency, income growth, and controlled lifestyle inflation will do more for your future than any dramatic, unsustainable overhaul ever could. By the 50s, something else starts happening, something that used to feel theoretical. In strong years, the growth on the existing portfolio can actually contribute more than the new money going in. The contributions that once felt invisible, $300 here, $500 there, have compounded into something that now creates real options. The choice to work fewer hours, the choice to retire a parent's worry, the choice to help a child without going into debt over it. This isn't a straight line upward, though.
There are recessions in there. Layoffs happen. Markets fall, sometimes hard, sometimes for longer than feels comfortable. Family emergencies still show up uninvited. The portfolio doesn't grow every single year, but it grows across 30 years. And that's the time frame that actually matters. At 62, looking backward, the day this all started doesn't feel early anymore, but it was. It was one of the earliest days this person still had left to use. 32 didn't feel like the beginning of anything at the time. It just felt like another ordinary Tuesday, with bank statements open and a slightly uncomfortable decision to make. But from 62, looking backward across 30 years of consistency, that ordinary Tuesday was everything.
So if you're watching this and you're 30 or 35 or even further along than you wish you were, here's the truth. Starting in your 30s will not build the effortless, picture-perfect financial life you see online, but it can absolutely build something better than that. A future that's secure, independent, and built on decisions you can actually be proud of. You don't need the perfect salary. You don't need the perfect market. You don't need the perfect budget or the perfect moment to begin. You need one honest decision, followed by years of imperfect, ordinary consistency.
If this resonated with you, hit like, subscribe for more videos like this, and drop a comment with the age you started or the age you're starting today. Someone scrolling past this exact video right now needs to see that number.